Welcome to the daily update, where I'll go over the action in the market for Monday, September 29th, and we'll see how things look for Tuesday, September 30th. All right, not much of a change. Looked like a promising start in Monday's session. We gapped higher, we're looking pretty strong, and then we ended up giving a lot of that back. And we didn't close at the high, we didn't close at the low. We never did go negative. We had a brief little move down right to the unchanged level, but then we're able to bounce up from that. And so we've got some pretty big data that could be coming out this week. And I say that because there's also this threat of a government shutdown looming around here. Complete political posturing. It might actually happen this time. We'll see. Things develop. There's 11th hour wheels and deals. And we'll see if that ends up being what we have to deal with in the upcoming week. And if there is a government shutdown, there's even a threat of the employment report on Friday not coming out, which is like, you mean they're not done putting that together yet? That's kind of where I come out on that. It's like this is a really complicated economic report. They pretty much have crunched the numbers by now and just doing some refining before it's actually released on Friday. I don't know that for sure, but you would think that that's how it would be put together. But this is a political tool. And when there's a government shutdown, they don't do the things in the back that nobody can see. They do the things that are right out front. They try to get the public involved. They're trying to deal with emotions here and fear and just all of that stuff going on. In the meantime, we're coming up to the last trading day of the quarter, and it'll be the end of the third quarter on September 30th once we close here. And there could be some window dressing going on. That could be positive, it could be negative. There really wasn't much going on in Monday's session, and so we haven't really changed all that much. We're still leaning positive. We're above the 20, 50, and 200-day moving averages, but not really showing any conviction in the short term. Last week, we were drifting over and turning over to more negative conviction. Didn't quite get there. Tuesday and Wednesday and Thursday last week. And then Friday, we had the update. That threw us back into kind of in between. And I'm talking about the short term here. And even with the positive close on Monday, it really hasn't changed anything all that much with our charts. Okay, so let's go back. Right at the open, we did have a gap higher open above R1. The futures were positive. We got above 60 or up to 66.60 and then above that level. And then we hit the intraday high at R2, 66.77. That was it. And that's why I like these pivot points so much. We see this day after day after day, especially on the 10-minute chart. I've used other 20-minute, 30-minute, 60-minute charts, what have you. It seems like the 10-minute chart is the most accurate for the pivot points. And I update those on the YouTube community tab every day. I have a website that you're welcome to check out. Everything's still free for right now. And I post the videos right away on the website where I delay them to be seen on YouTube and Rumble. So if you find some value in these videos, and they're meant to be watched before the market even opens, and they usually go public right when the market closes. So this is time sensitive information. Anyway, then as we went on, we chopped between R1 and the 6650 level, another round number that we're hitting here. And then we closed slightly above R1. We were up 0.26%, not a real big percentage move there. We were above average with volume, so we're seeing a little bit of positioning going in as the volume does pick up. We'll likely see an increase in volume on Tuesday because it's the end of the month and the end of the quarter. And we're positive on all three time frames, short, intermediate, and long term. Interest rates did come down a bit, and that was more friendly for stocks. We did get the latest inflation report last week with the core PCE. The market could have just tanked on that. It came in pretty much as expected and not really scary, but it's like, okay, we wanted it to be better than it was. And no, that's not what happened. The market actually ended up going up. And then we have all these domestic and geopolitical things that are going on that the market's not paying all that much of attention to right now. But there's the government shutdown, there's peace talks between Israel and Hamas and everything going on in Gaza. There was some escalations over the weekend between Russia and Ukraine. It's crazy world right now, but we, at least in with these videos, we don't really deal with those unless they actually have an impact on the market, and they're really not having much of an impact. Okay, some comments. The government shutdown is looming. Apparently, it's supposed to kick into gear on Tuesday unless some kind of a deal is reached. And then early gains in Monday's session were given back, although we did close positive. Mega caps and growth slightly outperformed, so that's holding up for right now. And if you watched any of the weekly videos that I do some pretty in-depth analysis between mega caps and the rest of the market and growth versus value, and that's holding up. But going back to the beginning of August, we've seen the market becoming a bit more defensive, and you'll see that in the charts when I get to them here. But it's not turning over negative. We're not seeing the bigger picture characteristic of the market switching from offense over to defense. It's still offensive, just a little bit of a concern as we finish out September, and then October can be kind of crazy too. You know, we've had some pretty good crashes over the 100 years or so, 1929, 1987, and October can also be a very good month as well. All right, oil did decline. There were some reports that came out that said OPEC Plus will likely increase outputs in November. So that's pushing oil prices down. A government shutdown would halt the Labor Department. All right, that's where we get the employment situation from. And again, it's like, didn't they crunch these numbers already? All right, anyway. And then we did have some Fed speak. Cleveland Fed President Beth Hammack, who's not a voting member, said the current environment is a challenging time for monetary policy. That's nice and clear and definitive, don't you think? And then we still have our stochastics looking extreme, and that's a slower chart because there's three divisions of the short-term time frame on that chart. And even though we're negative, we're coming down with the stochastics on the long term. We're still extreme. Now we're turning a little bit more positive with the shorter term stochastic, but I'll show you that chart there. No change to the overall scenario, but what did happen last week is with the stronger than expected economic data that came out, this idea that, oh yeah, the Fed's going to cut rates in October, they're going to cut them again in December, and we're looking pretty good for at least a rate cut in 2026. Well, that kind of got thrown into doubt. It's like, all right, if these economic reports are coming out, the Fed shouldn't be cutting rates. They should keep rates where they're at. And if it continues to show strength in the economy, maybe even raise rates. And so that's kind of got the market a little concerned for the time being. And the dollar was down. Now it's still in a short-term uptrend. It's been bouncing up a little bit, but this is really where the strength in all the different assets, stocks, bonds, gold, silver, when the dollar is weaker, it helps those other assets to do better. And interest rates were also down. We were at 4.14%, or after Friday, we were at 4.19%. We didn't change as far as sentiment. We're neutral. So we're not really leaning any way positive or negative from a sentiment aspect right now. We are still positive with the trend. The green line's still above the red line, but the ADX, both in the short and intermediate term, it's still below the moving average. And so it's not a strengthening trend yet, but the green line is above the red line. That's why it's positive. With the slight update, we are positive with the bias. I'm keeping the momentum at mixed just because in the short term, and this takes the last 2, 3, 4, 5, 6 trading days together, and this is a subjective analysis that I do. I like to have the charts really tell us what's happening, but I come up with this figure myself. But we're not really seeing anything as far as conviction, and that's really what I'm talking about with momentum. All right, so we just had pending home sales. Not a big day for economic reports. Up 4%. Now, they did think it would be up, but only up 0.4%. Last time it was down 0.3%, where we saw a little bit of weakness in this chart last time. So here it is. And I don't know what happened here with July. Maybe they were on vacation or something. We did get a report then, but there's nothing showing up here on the graph where we did see a bit of a pickup. And that could have been because generally over the summer months, the 10-year yield has been coming down. And the 10-year yield is what's tied to mortgage rates. And when we see interest rates going down, a lot of times we'll see the purchasing of homes actually going up. All right, man, we have a number of different charts here. Goldman Sachs, we saw this before. We've been going up, so naturally the forecasts are for us to go even higher. But here it tries to justify that by seeing an increase in earnings up this way. This kind of grayish blue line here, that is still going up. That justifies stock prices going up. And as long as they're going up, they also see a justification for the S&P going up. And they think 12 months from now, we will be at 7,200 with the S&P. All right, then we get this chart periodically as well. Discretionary, that just means you can kind of pick or choose. You try to time the market. Maybe you get out when things are going really bad. When the market's really going down, that tends to perform better. But then the systematic approach here is when you combine this with discretionary and then the systematic approach does outperform. But here we have the economic surprise index where we've been seeing stronger than expected reports actually coming out lately. All right, fourth quarter is here. We're just finishing out with the third quarter, and this tends to be the weaker time when you go back to 1950. Overall, we have been seeing a positive return, but then we get into the fourth quarter, and this is where things tend to perform better. Now, can be tricky, but when you take the October, November, and December all together, this is one of the better performing times of the year. Okay, now we get this chart a lot too, just showing that we're overvalued, but we've been overvalued for a long time. When we get above 20 with the S&P, that's when we're overvalued. Well, right now we're at 23. And we have industrials, discretionary, and tech. They're even more overvalued than the broader S&P is itself. And then even below that, communication and staples. And you could include materials right here. They're still right at the overvalued level. And then you start to drop down as we go down to the bottom here. Then government shutdown. A shutdown seems more likely than not in our view. Apparently, this is Goldman Sachs. But these situations are hard to predict even at the last minute. All right. The shutdown affects only programs funded by congressional appropriations, also known as discretionary spending. Defense is mostly discretionary and accounts for around half of the total. So it's like, okay, you're going to shut us down and then we don't have a military anymore. That's kind of interesting. But this tries to break it out, the different areas and what would actually be affected. The light blue, this is discretionary right in here. And defense is a big part of that. Where it's like mandatory, that's the dark blue. Social Security, health, interest, you know, it's like, all right, we'll have to see how that goes. And then gold, we do have gold hitting new all-time highs, so there's a lot of buzz around that right now. The value of GLD, that's the gold ETF, that's what I follow. Calls, puts spiked. Now is not a good time to chase long gold trade if you don't already have a long position. So according to this chart, we're seeing a real increase in the options on the gold ETF. And they're interpreting this as, okay, you might not want to consider getting into it now. Even though the gold bugs out there, the folks that really like gold, and there's perma bears that I follow, and no matter what's going on in the world, and I've seen this for decades, especially when they use Elliott wave, which I'm not a big fan of that because it's too subjective. You have to interpret that yourself. And they always have an arrow going down for stocks and an arrow going up for gold. And now the gold's actually been going up and setting new all-time highs and performing really well in 2025. They have the arrow going up even more, and then that sucks some people in, and we might be seeing some kind of a pullback. It's one of those things where the average person, when it gets to be looking like the right thing to do, that's when you should be careful. It's like this is meaning the party's getting kind of late right now. I'm not saying gold is going to reverse and go down. It's just that when people that don't follow this and don't really study it suddenly know about it, and the same thing happened with cryptocurrencies, Bitcoin. Yeah, people they don't even understand the first thing about the technology. They just see it as a way to put in a little bit of money, trying to get a lot of money back. Those are the people that aren't really well informed, and they usually get wiped out pretty quick. They usually get sucked in when they see something like gold or Bitcoin or what have you, even stocks, Nvidia, as it's going up. They don't know anything about the company. They don't know what they're really trying to do. They just see it as a way to put in some money, trying to get more money back. That's when it's getting a little too exuberant at that point. And according to this chart, that's where things are kind of coming out right now. Now, I just follow gold. I don't really track it all that carefully like I do the S&P 500. So this is just my own thoughts into different asset classes. And we saw that with the dot-com boom back in the late 90s. It's like people didn't know anything. They might have read a book or went to some 2-hour seminar, webinar, what have you, and suddenly they see this as a way to make some money when there's really a lot more that needs to be done before you become really proficient at it. And then things go up, everybody's happy. I mean, this has happened for hundreds of years. There's books written about this, tulips and land or big companies that didn't really exist and so forth, and it sucks a lot of people in. Everybody loses, wipes those people out, but then the people that were really studying things, they have more of a staying power. And then we go on and we find the next big bubble because people are always looking for an easy way to make money. All right, I don't know why I got off on that. And then global breadth here, all country world index. I do follow that in some of the weekend videos here, but this is showing how we're doing pretty good. And then this is also showing how new highs, new lows, they're looking pretty good lately, but starting to drop back a little bit. And then consecutive days when we have new highs and new lows. This is an internal measure. That's why we follow this for the S&P. The S&P might be going up, but if we're seeing new highs, new lows trailing off, that's a warning sign to us. But you take all of this together, and it's still looking fairly positive. Not as good as it was back as we were bouncing up out of the COVID crash, but it's still looking pretty healthy here. So global breadth is not just positive; it's relentless. Oh, okay. 73-day streak of more new highs than new lows marks the strongest run of worldwide participation. And I'm not into this since 2021 stuff because what was the context? We were going down at that point. All right. So to say the biggest since 1994, I just totally blow that stuff off. Anyway, that's where I come out. All right. So here we are with the intraday chart. Looked really good right at the open, came right up to the start R2 a resistance level and could not get any higher than that. And then we started to drift down below R1 and we tried to come back up to R1. Now this was acting as resistance. We went all the way down to the unchanged level and then saw some buying going into the close. So a little bit of late day strength there, which was positive and pretty much was enabled the S&P to close positive as well. Not much of a change. We're pretty much unchanged now in the initial overnight session. That's the pink area over here on the right. And we did see the futures were pretty strong and they stayed strong. And then we saw most of the weakness coming while the market was open. Then this is it's positive and negative kind of at the same time. We want the blue line above the red line. That's not happening. The red line's above the blue line. We want them both to be going up. They're kind of going up here. So that's kind of the positive side of things. But we're seeing the red line going up as the blue line's coming down. And that's a bit of a warning sign. We look at that and then we go, okay, what's been happening since the first part of August? We typically have been going up. And there are times when the red line's above the blue line. But the big takeaway is that we're going up and to the right. And we're kind of settling out here more in a range. It would be better if we could break to the upside with this chart. And okay here, but not great with the S&P growth of value intraday chart. We had been coming down as the market was getting more defensive. We tried to bounce back up, and now we're coming back down a little bit here. So not an awful lot of strength. We've been kind of plateauing. If you go back to the early to middle part of September, we haven't really seen a lot of movement with this chart. Not like at the beginning of September when this was really moving up and showing more conviction. Yeah, so end of day growth was up more than value for the large caps. It was down less for the mid caps, but up less for the small caps. So saw a little bit of a tick up here with small cap growth to value. Been a little concerned about this going up with the index, but this has actually been going down. In a more positive, uh, offensive market, you want to see the index going up and this ratio going up at the same time, and it's just not doing that. And we're a little bit better here with the mid caps going up here, a little bit more strength with the growth to value ratio that way. But the mid caps, they're like the worst performing index right now. And we're okay here, but not great with the S&P growth to value. We're still below the 50-day moving average. We want this above the 50-day moving average. We want it to be going up as the S&P has been going up. And you notice this was looking really solid, and then we hit August, and we were still going up with the S&P, but now this ratio has been coming down. And that's a little bit of a concern there. But it's been going on for a while, and the market's still holding up. We're still doing okay here with the growth to value ratio. Here, we're still at the top end of the rainbow. This is one of the more positive looking ones, discretionary to staples. That continues to go up. And we have been coming down with discretionary, but staples have been going down even more. And that's what's been helping this ratio to go up. And then here we are not trending. This is short term. We're below the moving average and declining with the ADX, but we are still positive because the green line's above the red line. We're still trending because we're above this blue line, which is a static level at 20. The same thing here in the intermediate term, below the moving average, so a weakening trend, but it's positive with the green line above the red line. And we did drop a little bit down here with our momentum oscillator, but if you look over here, we were slightly above average with volume for Monday's session. And then this is a weekly composite looking at sentiment here, and they still have it looking pretty positive. Where the daily chart that we look at, we're more right in the middle. We're at 53, where they're coming in at 72.34 here. I like the one that updates more quickly. I think that gives you more of a insight as to what's happening from a sentiment phase. But there's something to be said for this too, because this takes multiple different sentiment gauges, puts them together into a composite. All right, then this is put out by Goldman Sachs. They're still negative here. They have been improving, but this might mean that there's still more room to run to the upside before, according to Goldman Sachs, sentiment becomes really extreme. And then this is another way of saying, okay, what is the option market feeling like? Not getting a lot from here. We closed at 66.61. We had gone up to 6,700, and this was a reason, one of the reasons why we probably stopped right at that level last week when we tried to get to that level. We this blue line and this, you see, there's a lot of gamma exposure right at 6,700, and that produced overhead resistance, and we're still above this where we turn to red over here, the gamma flip. This is where it would actually turn more negative. We're still looking positive because we're in the green area. The next area to kind of watch would be the 6650 level. That's right about where this, you see the spike in gamma exposure that intersects with the blue line. And here's that same chart again, in case you missed it before. There were two different versions of this. I'll read what they said here. Our sentiment indicator, which measures U.S. equity investor positioning, has rebounded to minus zero point 0.6 after it had been minus zero point 0.9 4 weeks ago. None of the 9 positioning measures in our indicator are in stretch territory. Well, it's negative. How can it be stretched? It would be really positive if it was stretched to the upside. Now, this is a little bit of a concern here. We get this every Tuesday. I get the chart on Monday, but I don't talk about it until Tuesday. These are legal insider transactions, and we saw a huge spike up here. Corporate insider activity signals a bearish tone, with the insider transaction ratio reflecting both caution and profit-taking behaviors. This could put some pressure on as we're coming up into the end of the quarter. We're seeing some selling going on here. And this is an ETF. A lot of people really believe in insider buying and they track that. I don't. I think the data is too delayed. They do have to report it when you're the CEO or a corporate officer. You have to let people know what you did. But by the time we get that information, it's like way old news. But there is an ETF that tracks this, and this has been going up for the most part here as we've been going up with the overall stock market. Then this came out at a really strange time too, not usually when it comes out. Investors intelligence, we're still looking extreme over here. We're above this 3 level. That means that people that make recommendations, whether newsletters or websites or whatever kind of service they have, they're all leaning bullish right now. And when we get above this 3 level, that's where we start to get concerned. Now, it could go higher than where it's at right now. We just start to make note of this when it gets above 3. And we're still not really seeing any fear when it comes to the VIX. We actually ticked up a little bit, even though the market closed up slightly. But the closing value of the VIX, that's the line chart. And we're still right about at the moving averages with the bar chart. And we just haven't seen this develop, at least yet. This is the seasonality of the VIX going back to 1990 here. And this really goes up. And that means stocks are going down. But we're just close to all-time highs with the S&P. And not really seeing a real pickup here with the volatility of the VIX. We're down at the moving average with the bar chart. We did come up a little bit on a closing basis with the VIX of the VIX on the line chart. Now, this is something that we are seeing some fear here that's not getting picked up by our other sentiment gauges. When we get above this dashed line, this is a VIX to S&P 500 correlation, It's coming down now. We think it maybe has topped out and will come down. And if you go back where I have the red lines here, when it spiked and then started coming down, a lot of times what happened after that was a decline. Not always, but enough to be able to say we need to respect this chart and at least be open that there might be some declines. And this is a chart I rarely show in the daily videos. I usually show it in another video I do called the deep dive video, where I have other charts that I don't show in the daily videos and they're unique just to that particular video. Typically, this is one of those charts. This is a ratio between stock and bond volatility. Now, as we were going up here out of the April lows with the S&P, for the most part, this red line was going down. Now we're seeing this line turning back up. This is meaning that even though the VIX is not really moving all that much, when you do a ratio between stock to bond volatility, the VIX to the MOVE index, this red line is starting to go back up. And that could be a little bit of a concern. It's not what we've been seeing lately. There's a little bit of a shift that's been going on here as we worked our way through September. Now, this is a chart I show every day here. This is a fear gauge that actually declined. And then we saw a decline with this other fear gauge. And then I used this one and the previous chart to say, okay, these are confirming each other. We're seeing some fear coming out of the market. We were unchanged with our fear and greed index. The VIX didn't really move all that much, but this is showing that there's a little bit less fear after Monday's session. And then with a little bit of a tick up with the daily equity put call ratio chart. And we're bouncing back up after dropping below this red line. When we're dropping, that's considered positive. And now when we're getting a really low reading like this, it's like, okay, we're getting kind of extreme here. And now this is starting to come back up, but it hasn't crossed back above the red line yet. And this is a longer term look at that same chart where it goes back to 2005, right at the end of 2005 over on the left, to show that when we get a very low reading here, you can kind of match up. Sometimes that had an impact on what was happening in the market. And we're still declining with the 10-day chart. Now we're getting to a pretty low reading here. This is continuing to decline, which is seen as positive. Now, if it gets down to a really low reading, again, that could suggest that there may be some problems for the market, with meaning that it might go down. This is another thing too. We're going up with the S&P, and then we look at the risk on to risk off ratio. It's continuing to come down. The last few days, even on Friday, and then again on Monday, you would think this would go up on an up day. No, this has been going down on two up days that we've had back to back now. Now, the overall is that we're going up with this, and that's positive. But to see this going down on two up days, a little bit of a concern there. And we're still getting a high reading, even though we're dropping down a little bit with the volatility risk premium. This is picking up some fear that we're not seeing in the other gauges. That's why I look at a lot of different charts where we were getting a high reading. We are coming down, but we're still above this red band here. And the other time we had a high reading was right at the end of July, and then we had the employment report come out, and the market tanked. Didn't last very long, but we did really drop down before going back up. Freaked out a lot of people. We dropped below the 20-day moving average, but then we quickly got back above it. So we just want to keep an eye on this. This is, even though it's coming down a little bit here, it is giving kind of a higher reading than one we've seen lately. All right, but the advanced decline line doing okay. It did go up, but not setting a new all-time high based on price. But this is more positive. We're setting another new all-time high based on volume. So when volume is leading price, and I hit that hard over the weekend in the weekly videos, that should be taken as positive. When we're going up and we see volume actually outperforming price, that is a positive thing. But it's price, that's what we ultimately have to follow. That's the ultimate indicator. So this is still looking positive overall, even though volume is doing better and price hasn't quite caught up. The hope is that at some point it will catch up. And then we're back above zero here with the short and intermediate term advanced decline ratio. We're finally climbing back above zero with the advanced decline oscillator. But as we were going up here, you see, we set a high back in May, then a lower high, then a series of lower highs. And so this is a longer term negative divergence. And then, so we keep that in mind. That's bigger picture. But then now that we've gone back above zero, that's turning this indicator more positive again. And if this continues to go up, it could blow out all of these negative divergences that we were seeing here. And this is another market breadth issue, and this is a little bit different than how I measure it, but it had us really coming down, but yet improving. And this is still looking more positive now that we're going up. And then we are seeing a bit of an expansion of the new highs, really no new lows. So we're trying to turn up with the 5-day chart, but we haven't crossed the moving average. We are starting to go back up with the 10-day chart. And this is another internal measure that we're seeing here. And this is improving and holding up. And as I said over the weekend, we're seeing a lot more green than we are red. That's really the takeaway from this, no matter what the moving averages are telling us. And we're still doing okay here in the longer term with the smart money indicator number one. We're above an advancing moving average. Now, the boom indicator is shorter term, and we are going up, but we haven't crossed above the moving average yet. So the context for this would be that we're improving, but we're still negative. And we did come up with the histogram with the chicken money flow, but we're at best we're just kind of flattening out here with the red line. So we had been negative and we haven't actually switched over to positive with this indicator, but improving. Where we are more positive now with the chicken oscillator. We're advancing above the moving average and we're looking positive here. The green line is above the red line with the vortex. And we are seeing a bit of a breakout here with the cumulative advanced decline line for the S&P. That's making a new high where price is not. And again, that's another thing inside saying that, okay, volume seems to be outperforming price. That could end up being a positive thing. And we are back above the moving average with the S&P. We're still below the moving average though with the NYSE common stock, mid caps and small caps. And those declined where we saw the S&P actually advance in Monday's session. And we're back above 50 with those stocks above their 20-period moving averages. Again, negative divergence, lower highs as the S&P was going up. Then shorter term, we were having a really difficult time getting back above 50. That's the line between positive and negative. Now we're getting back above 50 here. So we are seeing some improvement, but it's far from showing a lot of conviction. And we're also positive and seeing these negative divergences with the 50-period moving average study. A little bit of an improvement as we were drifting off here with the S&P going up with the 100-period moving average study and some improvement here with the 200-period moving average study. So these are not falling apart. They're not really showing a lot of conviction, but especially in the longer term, this is still looking more positive. So short term, and now we're finishing out with September, and that's what this dashed line is here, and that's about where we topped out at about 6,700 for the S&P, and then we fell back. We're trying to go back and see if we can give that another test again. Is that going to matter if we click over into October? Now, sometimes these pivot points, they'll still be in play even though we go to the next month. That's why I keep them on the chart right here. But we will have new pivot points that will start on Wednesday for October 1st session here. And then on the bottom, we were just barely above average with volume and a little bit of an improvement, slightly above 50 with the 20-period moving average, 50-period moving average, and 200-period moving average. A little bit of a tick up there. And we had already become extreme negative with the Stochk RSI. Well, with the two updates that we've seen, this is now no longer extreme, but it's still below the midpoint. And we're not quite back up to a positive reading here with the Williams percent R and improving, but not extreme with the CCI 14 and the CCI 20 chart. Now we are improving with the short-term stochastic. 2 days up and we're back above the moving average. Turning up here, but not above the moving average with the intermediate short term. We're still declining with the long short term below the moving average, but it's still above this green line, which is giving us an extreme positive reading. And a little bit of a tick up, but still below the midpoint with the force index. Still looking pretty good here with the short-term trend based on 20 periods. We are seeing enough of an upward move here that the lines are starting to go back up. But we need to get above it, stay above it, and see these lines continue to go up to remain positive. And then it was last Thursday when we came down to the 20-period exponential moving average. That's the blue line. And that provided support. And we were able to bounce up off of that. And is that going to last? That's happened before here as we've stayed mostly above the 20-day moving average since the April lows. And we're still in the +2 channel with the standard deviations chart. That's positive. Then intermediate term, we did decline a little bit, but we're still above zero with the balance of power. Positive with the go, no go. And we're above the midpoint with the highest high value chart. Day 104 of this uptrend, according to Landry Light, that started back right at the beginning of May. day 98 here with the proper order uptrend. And we're still seeing a little bit of weakness here. The TTM squeeze actually is turning dark blue. That's negative. When it's light blue, that's positive. So to have an up day and for this to turn negative, it's picking up something it doesn't quite like. And we're still slightly above zero here with the ease of movement. We're actually declining now with the Arun. We're seeing the buyers tapering off, the sellers starting to pick up. The difference between the two is the oscillator down here. We're still above zero, but now we're seeing some weakness coming into this indicator. And then we were just barely above zero after Friday with the S&P McClellan oscillator, a little bit more above zero. Also, you can point out the negative divergences here. If we see a real upward move, it would negate that. But we've been seeing this now as the S&P has been going up. But then you take the raw value of this, the fact that it's above zero, that's positive. So we're starting to tick back up again here based on price, and we have been going up based on volume. Another example of volume outperforming price. Excuse me. And how many dots you see here shows us how much conviction there is. Not many dots down here with price. More dots here down below when we look at this based on volume. And we're still below zero, not much of a change with the NYSE McClellan oscillator, so that's still negative. So we're declining with the summation index based on price and volume. Positive with the swirling trending oscillator, crossing back above zero. Now, after Friday, we were still below zero based on price, but positive. And we never did drop below zero here based on volume. Another indication that volume's been outperforming price. But now we're seeing a little bit more confirmation as price crosses back above zero. And we're turning up. It's still below the moving average with the PMO, but we're above the moving average when we look at this based on price with the PMO. Now, the PMO itself, this is a momentum oscillator, and they lag a little bit, and it's been coming down, but it hasn't quite crossed over negative. Seeing a little bit of an improvement above 52 with the PMOs that are rising. We're improving with the buy signals, but still below 50. And we're flattening out after declining with the PMOs that are above zero. And we're pretty much on the moving average with the short-term slope oscillator. We're just a little bit below the moving average, possibly with the MACD, but not showing an awful lot of conviction there. So we're seeing a little bit more vulnerability in the short term, a little bit of weakness here in the intermediate term, rolling over just a little bit with the long-term oscillators, but they haven't crossed below their moving average. And we're right on the moving average with the copy curve. And that's why I say a lot of these things haven't changed, even with the slight up day. This is what I'm talking about. We're not just seeing any real changes in the charts. Still looking positive though with the money flow since we're above 50. We're also above 50 with the ultimate oscillator. We're still going up in this initial darker green area with the Sean trend meter. That's positive. Still above an advancing moving average with on balance volume. That's positive. Still above 50 with the intermediate and short-term oscillator, and both are advancing. That's positive. We're neutral though with the Elder's Impulse system for the S&P, but we're negative now for the third trading day with the parabolic SAR. Now, if we do see a real upward move and we take out this previous high, that might switch back. But for right now, we don't know that's going to happen. What we do know is that there are three dots on top right now, and that is negative for the parabolic SAR. Just as a side note, over the weekend, the weekly parabolic SAR is still positive. The dots are underneath. And we're still above this 10-period simple moving average, the green fluorescent line here. That's positive in the short term, and we're above all the lines. The lines are continuing to go up. So this is still suggesting that the short term is remaining positive and even somewhat into the intermediate term. And we're still positive here. The intermediate term trend based on 50 periods, the red line and the blue line continue to go up. We're above all the moving averages, and all the moving averages are going up. If we do see a decline, just like last Thursday, we'll be watching these 20-period moving averages if they provide support. And we're back to seeing price a little bit too far away from the 200-day simple moving average. Now, again, this dashed line, there's nothing magical about it. It's just a threshold. It's when we get 11, 12, 13, 14% above it. That's when we get even more concerned because you see back in 2023, when we got above the dashed line, too far away from it, that's when we saw a decline. We saw it happen twice in 2024, in April and then again in July. We got too far away and then we saw a decline and then another decline. Now, I was watching for a decline going into July of 2025, But I did a video and I said, if there's one thing that doesn't suggest that we might see a decline, it would be this chart. Because we were even in the middle of July, we were down well under this 10% level. Well, now we're above that 10% level. We did drop down a little bit, but now we're back above it. And this is another study by Fundstrat here. The S&P not super overbought. This is what also measuring how far away are we from the 200-day simple moving average. And it implies we're going to get to 69.50. Okay, what I'm focused on here is how much of a percentage. And this kind of points out what I was showing in the previous chart here. And we're just a little bit over that 10% level now. And they think that when we get to 13, 14%, and that's about what we saw back here, that's when we get a little bit more concerned. All right, bullish percent index did bounce, but still below its moving average. So that's still negative. A little bit of a tick up with the NYSE bullish percent index and a little bit of a move up with the NASDAQ 100 bullish percent index. Still at the upper end of this trend line going back to 2009. That hasn't changed. This is another trend line. Now, I don't do charts this way. This to me breaks all kinds of rules here. You should be connecting high to high. They're trying to form fit a trend line on here. They're going out into the future and saying, okay, I like this high, I like this high, then let's just send it back. Even though we broke above it here back in 2022. So, and then they're trying to say that we're at the midpoint here, and this is still looking pretty good overall. So the S&P remains near the bottom of a very strong trend channel that's been that way for the last 3 years. They're not even accounting for these big down moves that we've seen here, both back in 2025 and then the lows back in 2023. To me, this is where somebody looked at a chart and decided what they wanted it to look like before they even drew any lines. I don't like to do things that way. Now, some of you might disagree. Let me know. And then here is the weekly chart of the S&P. We're still looking good. We're above this R1 pivot point. And we're doing okay here with the trend. The Heikin Ashi is positive. The Kegi is black and pointing up. That's positive. We're going up with the Renko, but we're still looking a little negative here with the three-line break. And we're still doing okay with our 150 and 200 period moving average studies here. Negative again with mid caps in the short term. Everything else is positive on all time frames. Positive in the short term with the dollar, still negative in the intermediate and long term. And we had energy that was down. Now, it performed pretty well last week, so it actually took a bit of a bath here on a sector basis in Monday's session. But we had tech leading, discretionary, so that's good. Communication, not we want to see these three at the very top to be quite positive, but the percentage gains just not really all that much here. And so we started off today looking pretty positive with the Nasdaq going above 22.5, then 22.6, 22.7. Utilities setting a new 4-year high. They've been seeing some growth lately because of all the expansion of AI and all the need for electricity. We did have oil going below 65, gold setting another new all-time high above 3,800. And so you have both Google stocks down a little bit. I kind of drug down communication, even though we did see some green in here. Nvidia and Microsoft were up. Apple was down slightly. We had Oracle down a little bit. So just kind of a mishmash here. Some green areas, some red areas overall. And the Dow is still having a really difficult time getting above this pivot point here. That's pretty much where we topped out on a closing basis. And we're coming right up to that level again and cannot seem to close above that for right now. So if we do get above it and close above it, that's going to be taken as something positive. And we've gone from neutral to positive with the diamonds. With the Elder's Impulse system, we're above the pivot point again here with the NASDAQ, but we're still neutral when we look at the Elder's Impulse system. And we're right at the pivot point now with the NASDAQ 100. We came a little bit above it before, dropped back. Now we're right back up to that level. If we can get above it, stay above it, and then kick over into October's pivot points, maybe that will be more positive. And we're still neutral though. And you can see we opened, we set a high, and we closed pretty much right at the open for the NASDAQ 100 or the QQQs here. And we are drifting down a little bit, but we're still hanging on to being positive with the momentum for the NASDAQ 100. Still above this trend line, going back to 2009 on the weekly chart of the NASDAQ 100. Just chopping around like bumper cars now with this S&P 600 small caps. And up a little bit here, but not very much with the Russell 2000 small cap index. And still neutral though, with the small caps looking at the Elder's Impulse system. and just kind of moseying along. We came down to the 200, excuse me, yeah, no, 50-day moving average here, and then bounced up off of that with the mid caps. And so that's a support level that held. And this was the same day we hit the 20 period moving average with the S&P. Again, that's why I follow lots of different indexes. Not really showing a lot of strength. It was actually down a little bit, but we're still hanging on to being positive with the mid caps. And they're neutral after being positive with the Elder's Impulse system. Coming back up, bouncing a little bit here after recent all-time highs with the Wilshire 5000 and the total U.S. stock ETF. Still above the 50-day moving average, up 0.5% with the financial sector. But in the bigger picture, going back to about April, the financial sector continues to underperform the S&P. And the FANG index closing way off of its high here, not at a new all-time high, but still looking positive in the bigger picture. So Apple was down 0.4%. We were up over a percent with Amazon, up 0.61% with Microsoft, still dealing with its 50-day moving average, down over a percent with Google after it was just going to the moon there for a while, and a little bit below the moving average with Meta, and right about at the 50 period moving average with Nvidia, up over 2%. And then Tesla, it just has been doing really well lately, up 0.64%. And then Netflix is dealing with a declining 50 period moving average. And still seeing a bit of a drop off here when we look at the correlation between US and world stocks in the short term, trailing down just a little bit here with the longer term correlation. Coming back down into the mid 60s with oil, we were actually up more than that. We were getting up into the higher 60s, the still at the midpoint, but the higher end of the middle. Now we're getting to the lower end of the middle. And the dollar is still above this moving average here, dropping down just a little bit, but we are in a downtrend, both on this daily chart and then the weekly chart that I do in the weekly video. That's in a downtrend as well. And we are coming back down here with the 10-year yield. If we could continue to drop with that, that would be more positive for stocks. And we're going back up a little bit here with the 10-year yield. And our growth to value ratios doing okay with Qs to the S&P, coming back above the moving average with discretionary to the S&P, not looking really strong, but still above the moving average when we compare large cap growth to value. So still below the moving average with the large caps, still above the moving average with the mid caps, still below the moving average with the small caps. All right, so we're still positive on all three time frames, and I use moving averages to determine that. We're above support. That's the weekly chart of the S&P, but there's really no conviction happening right now. We're going to get the FHFA Housing Price Index, the S&P Case-Shiller Home Price Index, so we're going to get some housing data on Tuesday. Consumer confidence, sometimes that can be a big deal, but that'll come out later in the day. The Chicago PMI, that's more regional to the Midwest. And then the JOLTS job opening should be on here as well, but it didn't show up on this version here. And then anything geopolitical that may happen. There's so much going on. It's like the market's just in its own little world currently. Yeah, here's the JOLTS job openings for Tuesday. And then we'll get ISM manufacturing. That's a big report. That'll come out on Wednesday. We'll get jobless claims and continuing claims on Thursday. And then if we don't have a shutdown, we should get the employment report, and then we'll be getting ISM services as well. So later in the week, it's pretty heavy with economic data. This also shows what the previous readings were, and then if there's a forecast as we work our way through the week. Seasonality, though, we are negative for September 30th. When we look at the Dow and S&P, we're neutral to negative with the NASDAQ. And then we'll roll over after Tuesday's session, and we'll start looking at October's numbers. And then we're on the last trading day here. We never did see any of this real weakness in seasonality that we typically see throughout the month of September. But September tends to not perform well, but this could be an exception. Unless we have a massive down day on Tuesday, we're going to be pretty good in 2025. This also shows how September typically underperforms. And this is the second half of September. Just to move ahead a little bit, the third best performing time in the year is the first half of October. I don't have it marked. I'm just trying to highlight it here with the pointer. And then this also shows weak seasonality that really we have yet to see. There's one day left to try to see that weak seasonality. This also shows that historically, going back to 1950, September tends to not perform well. Now, here's the October chart. I haven't marked any of this up yet, but this just gives you an idea. And we're mainly following the green dashed line here. This is the S&P during a post-election. And this typically does okay. If we see any weakness, it's a little bit later in the month. This also shows more of the whole year taken together, kind of where we're at here. This is 2025, and we've been outperforming both the post-election years going back to 85. That's the green line. The purple line is the aggregate from Stock Traders Almanac. And you take all post-election years together, and the red line is still above all of them. And so they're asking the question, are we going to see a monster rally going into the end of 2025? All right. And then this shows the statistics going back to 1950. I'll highlight this as well, where we tend to be up in October. We're up 11 out of 18 times, down 7 out of 18 times. All right. So three smart money indicators. I still have them on the negative side here because in the short term accumulation distribution, we improved, but the boom indicator is still negative. Chaikin money flow hasn't, it's flat right now, but the Chaikin oscillator is positive. And then we have the McClellan oscillator and summation index for the NYSE. Even though they both improved, or actually the McClellan oscillator did, we're still below zero. Parabolic SAR is negative, as is the bullish percent index. It bounced up, but not above its moving average. Then on the positive side here, the growth to value ratios, bigger picture, and discretionary to staples, actually short and bigger picture. These are still looking good. Now we're seeing some weakness, kind of drifting down with our momentum oscillators, where we are positive just a little bit here with the McClellan oscillator based on price, looking more solid here based on volume. And we're seeing that also with the summation index. Swollen trending oscillator looking a little better. Volume is outperforming price, and we are still positive. Now, I look at these that I in a different way than I do for the S&P. If we're above 50, that's taken as positive for the Nasdaq 100 and NYSE bullish percent index. I put a moving average on the S&P bullish percent index, and if we're above or below that, that's positive or negative. Ease of movement, money flow, ultimate oscillator, and the vortex. Those are positive. Positive with the momentum, although we're seeing some weakness with the Nasdaq 100. Financial sector, positive, but underperforming the S&P. It seems like forever that this has been on here. And if you watched any of the weekend videos, I show both the daily and weekly special K long-term momentum oscillator. Both of those are still positive. And here are the pivot points for Tuesday's session. Okay, so we are positive and we're above support on all time frames. We're still not really seeing any conviction in the short term. If we decline, we'll be watching the 20 period moving averages. And we're seeing some things improving, but some things not really improving in the intermediate term. We're positive in the long term, but we're more than 10% above the 200-day simple moving average. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.